Capital growth or cash flow, the age-old debate. All right, it's really not, but it is something that gets asked quite a lot. You know, when I'm investing in property, is it capital growth I should be looking for or cash flow? And that's exactly what I'm going to be covering in today's video. The first thing worth mentioning is there is no accurate answer. It's all based on your opinion and where you're at. There is no one size fits all situation that we're going to be moving forward with. What I'd have in my mind is cash flow is money today. It's looking after you today. And capital growth is all about money tomorrow, or what I like to call generational wealth. And there's going to be a few factors that you need to take account of as you're going through your investment journey, because the answer is going to be dictated by your current position today. What I'd be asking myself is, what's more important? Is it the long-term generational wealth, or is it what a lot of us in the industry call financial freedom? Financial freedom, if you've never heard that term before, is when your outgoings are lower than your income through your assets. So i.e. your passive income covers your monthly outgoings. If you are spending £2,000 a month, but your portfolio is paying you £2,500 a month, you are financially free. So it has nothing to do with your net wealth. Somebody that's earning £1,000 a month could be financially free. Somebody earning £10,000 a month could not be financially free. It's all about the assets covering your liabilities. So this is going to be really important based on where you're at today. If financial freedom is your goal, replacing your job, maybe quitting your job, or making sure that these monthly income is covering that from a financial freedom point of view, then cash flow is going to be your highest asset that you're focusing on. So when I'm looking at that financial freedom cash flow metric, I'm looking at what return on capital employed I'm going to be getting. What this means is what return on my cash that I'm leaving in the property is going to be a great return. And in my opinion, anything upwards of 8% return on my capital is going to be a strong cash flowing investment opportunity. So I tend to work on these opportunities for myself and my investors, because a lot of my investors are looking for that mid-level of great capital growth and cash flow. So we focus on 8% return on capital, 2 to 4 bed houses. I don't really like flats, and these are going to be in strong capital growth areas. On that note, by the way, if you've got 100,000 or more and you're looking for somebody to build your portfolio for you hands-free, put APG in the comments, and my senior investment consultant Toyin will be in touch over the next couple of days. On the flip side, if you're looking at generational wealth, then you might end up focusing on lower yielding, low return investment areas. For example, if you purchase a buy-to-let property in London, your return on cash is actually going to be quite low, but you would expect your capital growth to increase a lot more dramatically over time. The truth is, this is transitional through time. There's actually 3 core stages of property investment that you're going to be looking at. These 3 stages are as follows. Stage 1 is a high cash flow, typically lower capital growth. So a very typical area of this in the past would be the Northeast. So the Northeast, Darlington and places like that, you're going to get a great return on your capital. Previously, the Northeast would be a really high cash flow strategy, but capital growth really wasn't there going back a few years ago, whereas actually the Northeast has now had some of the strongest capital growth outside of Yorkshire and the Humber, hence why I invest in Leeds. That's had the strongest capital growth over the last couple of years. But these sort of areas are going to be great if you're in the situation where if replacing your income is your highest value right now. So maybe if you're looking to quit the job. Personally, I've never been a massive fan of these. I try to skip this as much as possible, which is why I focus on saving a bit more and investing in a higher capital growth area. But if you hate your job and you just want to get out of it, then this is going to be a really good way for that to happen. So that's stage 1. Stage 2 is kind of this mid ground. So, you know, we're saying good cash flow and good capital growth. This is going to be where you're kind of getting the best of both worlds from here and number 3, which I'll go through in a moment. Normally, once you've replaced a job or you've got a great income, or like me, you just want to jump into this, you're going to focus on areas that gives you really solid returns, both from a cash flow, financial freedom perspective, but also that capital growth perspective. So for me, I focus on Leeds and surrounding areas, Wakefield, Huddersfield, etc. And I'm looking for an 8% return on my capital, solid 2 to 4 bed houses near a great school with great capital appreciation. So what I'll put there is Leeds. This is your stage 2. What people then do is move to stage 3 of wealth. And this is really quite confusing if you're not at this stage. But this is usually when you have really high capital growth and lower return, so cash flow. So these are known as low yielding areas. So actually what you'll find sometimes is the really wealthy individuals investing in property, they'll actually buy property that either is cash flow neutral, i.e. it's just the asset that's making the money, versus, or even some people have a negative cash flow. So they're actually losing money by holding that property, which may sound crazy to a lot of you, but actually this is where true wealth is made in property, which I'll finalize in a moment. A really good example of this in the UK is London. Over the long term, there is no area that is going to have better, significant and consistent capital growth rather than London. Now the way that this would work, by the way, as an overarching portfolio is, imagine you live off of this, your Leeds properties. This is going to help you quit your job, whatever you actually want to achieve. And then this one here, your cash flowing properties, is used simply to pay down your capital growth properties. Now, why is this so important over the long term, and why is it in capital growth why we actually make the most money in property? When you're looking at cash flow, you are looking at the next couple of years because you're focusing on the money now. But if you're investing in property, you need to have a long-term mindset with this. So let's break this down over a 20-year period. Now, naturally, over that time, you are going to get increases in rent and things like that. But if you're focusing on cash flow, how much does it actually earn you over a 20-year period? Well, let's break this down. If you've got a £100,000 property, and let's base that on this. So we've got £100,000. Realistically, that's going to be rented at about £600 a month. After the mortgage, etc., you're probably looking at about £250 net, minus the mortgage, management, voids, maintenance, whatever it is, which is £3,000 a year, £250 times 12, right? So if you've got £250 times the 12, that equals £3,000. Now, there will be some rental increases in this, but let's keep it as simple as possible. So we're going to do that £3,000 over a 20-year period. So we're going to times that 20 years by £3,000, which over that period gives you a £60,000. Okay? 3,000 times 10, 30 grand, times it by 2, £60,000. So you're getting £60,000 per annum. Pretty cool, right? Because over a 20-year period, you are getting yourself a 60% return on the value. But bear in mind, return on capital employed, for that 100k property, you've actually only put in a £25,000 deposit. Okay, plus some fees, let's say call it 30 grand all in. So you've made a 200% over 20 years return on your capital employed. But what about capital growth? Is it as much or is it a lot more? If you've been listening to my videos, you'll know how exciting it really gets through capital growth of property over time. So how does capital growth compare to this? Well, again, we'll do it on the full value of the property. The long-term average property capital growth in property is about 7.8%, by the way, but let's conservatively say 5%. Worth saying at this point, there are no guarantees in growth in property, but since 1086, the Doomsday Book, where you could purchase all of the land in the UK for about 70 grand, property prices have doubled on average every 10 years, all the way up to about £250,000 or over £250,000 per property on average in the UK. So the past isn't a guarantee of the future, but 1,000 years is a fair indication, I would say. If we are year zero at 100,000 and we are increasing at 5% a year, it's easy to think at year 5 we'd be at £125,000, right? But actually you need to bear in mind it's 5%, which is 105 grand, and then 5% on that 105 grand, and it compounds and compounds and compounds. So the way you do this on a calculator is £100,000 times 1.05, and then just keep hitting that equals button. So in year 5, you don't have 125,000, you have around 127,500. Over 10 years, you don't have 150 grand, you've got 162,500. 15 years, you don't have 175 grand. This is where it jumps. You've got 207,800. And then in 20 years, you'd be expecting to double that money, right? Which you do. You've got £265,500-ish. So you can see that growth. If you remember when I talk about these graphs, it's not linear growth like that, it's actually increased like that as we're going up. So if you are focused on long-term generational wealth, whilst you can't guarantee capital growth, you really want to focus on the areas that has the best schools, has the best infrastructure, because those are the things that drive up this capital growth, and that is where you are going to become a multi-millionaire in property, whilst cash flow is what's going to allow you to become financially free. As I said, there's no one-size-fits-all opportunity in this. If you're focused on the financial freedom right now, then cash flow is what you're going to want to be focusing on. And if you're focusing on becoming generationally wealthy and becoming a millionaire, then that capital growth is what you're going to be focusing on. But what one is it you're focusing on right now? Let me know in the comments with either a CF to represent cash flow and financial freedom, or is it CG representing capital growth and generational wealth? I'm genuinely interested. Let me know which one you're focusing on right now. And if you got value from this video, make sure to smash the like button. And if you're new to the channel and interested in scaling your property portfolio, make sure to hit the subscribe button and the notification bell. And of course, I'll see you in the next video.